In a tighter environment, CEO Jamie Dimon has cautioned against American consumers squandering down extra money. Nathan Stoval, Director for Financial Institutions Research at S&P Global Market Intelligence, commented on Dimon's warning and said he thought the CEO may have been trying to throw out some caution in his words. Let's dive straight into the topic. James Dimon, a multi-billionaire American banker and business entrepreneur, born on March 13, 1956, has served as chairman and CEO of J.P. Morgan Chase since 2005. The Federal Reserve Bank of New York's board of directors previously included Dimon. In Time magazine's listings of the 100 most influential people in the world from 2006 to 2011, Dimon was listed. As of June 2023, Forbes projected his net worth to be $1.6 billion. He went to the Browning School and graduated summa cum laude from Tufts University with majors in psychology and economics. Jamie Dimon, CEO of J.P. Morgan, has once again issued a warning over the U.S. economy's resilience, which has persisted despite the Federal Reserve's constant cycle of rate hikes. I simply believe it is erroneous for people to focus only on current data and ignore the future. And there will be quantitative tightening in the future, Dimon warned at a business conference. He was referring to measures that reduce market liquidity. This battle in Ukraine is still going on, and we've been spending money like drunken sailors everywhere. That is a lot of buts. Saying that the consumer is strong today and that this necessitates years of economic expansion is a grave error, according to Dimon. Inflating asset prices, rising salaries, and COVID-era savings have all helped to support American consumption. But he warned that this stockpile may be diminishing and normalizing. In fact, according to experts at the Federal Reserve Bank of San Francisco, consumer savings from the epidemic era will exhaust in the current third quarter. In early August, senior economist David Rosenberg warned that the Fed's fast rate hikes and the start of student loan payments might lead to a consumer-led recession. Dimon's warning about the economy matches similar views by well-known analysts. Additionally, according to a Bloomberg survey of investors conducted this week, more than half of the participants believe that personal spending may decline in early 2024. Any changes to the indicator are significant because consumer spending makes up around 70% of the U.S. GDP. After all, despite the Federal Reserve's constant round of rate hikes since March last year, the U.S. consumer's tenacity has kept the economy afloat. According to the Bureau of Economic Analysis, the U.S. real gross domestic product, or real GDP, increased at an annualized rate of 2.4% in the second quarter of 2023, significantly exceeding Wall Street's projection of 1.8% growth. Insider filed a comment request to J.P. Morgan after regular business hours, but they did not react immediately. According to Dimon, businesses feel pretty good because they look at their current results. But those things are subject to change, so we are unsure of the full impact of all of this in 12 or 18 months. Despite the fact that J.P. Morgan and other banks have been over-earning on lending for years due to historically low default rates, Dimon noted that there were cracks starting to appear in the subprime auto and real estate lending sectors. According to Dimon, if and when you have a recession, which you will eventually have, you'll have a really normal credit cycle. In a normal credit cycle, something always does worse than anticipated, he continued. Throughout the panel discussion, Dimon sounded a tone of caution. According to him, J.P. Morgan is repurchasing stock at a lower level than before, and this pace may continue through 2024 as the bank manages its capital to comply with forthcoming regulations. He criticized the new regulatory requirements as hugely disappointing and urged authorities to be more transparent. He claimed that J.P. Morgan would need to retain around 30% more capital than European banks. Are they seeking that? Does that work in the long run? Dimon inquired. What the goddamn hell was the point of Basel in the first place? When questioned about whether the IPO and merger markets were gaining momentum in light of the impending ARM listing, Dimon responded that he advised CEOs to move right away rather than procrastinate. Dimon stated, "I believe the uncertainties out there ahead of us are still very great and very dangerous." He said that worsening relations with China is one of those risks. Because of the increasing risks, he said, the outlook for JP Morgan operations in China changed from looking good to merely just okay. "Although I don't anticipate war in Taiwan, things could go wrong," Dimon remarked. Since tighter monetary policy has a lag, it's frequently difficult to predict when rising interest rates. During the question and answer period, Dimon appeared to make a reference to that by saying that business results could radically alter in a year. "Businesses feel pretty good because they look at their current results. They're not so bad," Dimon stated. "However, those things alter, and in 12 or 18 months, we don't yet know what the entire impact of all these things will be. In an effort to combat inflation, Fed policymakers have dramatically increased interest rates during the past year, authorizing 11 rate increases. Interest rates rose from almost 0 to over 5% in a year, which is the quickest rate of tightening since the 1980s. The CEO of JP Morgan sent a cautionary statement to all participants in the economic environment. Businesses may reevaluate their plans, investors may review their portfolios, and politicians may need to explore possible initiatives to boost economic activity. This warning implies that the chief financial officer of a significant organization sees indications of potential difficulties in the future, demanding a closer investigation of the current economic situation. This shift in consumer behavior may be caused by a number of variables. These changes are essential indicators for people navigating the financial landscape, whether they are brought on by economic uncertainty, geopolitical tensions, inflation worries, or the lingering repercussions of the worldwide epidemic. Reduced consumer expenditure could have wide-ranging effects. Businesses may see a decline in revenue, which might have negative effects including job losses, reduced output, and a general downturn in the economy. In response to such warnings, governments may consider a range of policy approaches to boost economic growth, including changes to interest rates or fiscal stimulus programs. It's critical to place this warning within the larger framework of the world economy. Due to interconnected financial markets, trade links, and shared supply chains, economic conditions in one region can have repercussions on the rest of the world. As a result, the CEO of JP Morgan's cautionary remark is significant for the particular market, as well as for a larger understanding of the interrelated forces influencing the course of the global economy. The personal savings rate fell from a record high of more than 33% in April 2020, when the government began distributing more than $931 billion in stimulus checks to Americans, to just 2.3% in October, the lowest level in 17 years, according to the Bureau of Economic Analysis. The spending binge that has kept consumer demand growing quickly this year increasingly seems to be coming at the expense of savings and credit card balances, with credit balances now exceeding a pre-pandemic peak, according to a Morgan Stanley team led by Lisa Chalette. According to Chalette, the robust consumer spending will likely slow down next year unless the labor market stays very strong, which will put more pressure on the economy, which has already seen recession prospects rising materially. The job market did surprisingly well last quarter, and consumer spending reached a record because of government stimulus measures from the epidemic era. How long the strength might stay, though, is a concern among experts due to persistent inflation. Nigel Green, the CEO of wealth management firm DeVere Group, advises investors to exercise caution. He continues, "While it has cooled, inflation is still way too hot for central banks to step down from their agendas just yet." Despite a decline from a peak of 9.1% in June, the Consumer Price Index's annual rate of 7.7% is still almost 4 times the Federal Reserve's long-term inflation objective of 2%. The CEO of JP Morgan's warning of a tighter economic climate, in conclusion, represents a comprehensive knowledge of the interdependence of many economic indicators. Consumer expenditure declines and the use of savings are warning signs that demand attention. These signals should be taken seriously by policymakers, companies, and individuals alike, since they could portend larger economic problems and call for tactical actions to deal with the changing financial landscape. To lessen the potential impact of these tightening conditions in the coming months, a judicious combination of policy measures and company resilience will probably be necessary. What do you think of the CEO of JP Morgan's remarks about the tighter environment? Please leave us a comment with your opinions. Subscribe to our channel for more captivating tales like these. And don't forget to click the bell button to receive notifications. Goodbye, until then.